All right, let's dive into a topic that, let's be honest, trips up a ton of accounting students and professionals: deferred income taxes. If you've ever stared at a balance sheet and wondered what that deferred tax asset or liability really is, then you are in exactly the right place. We're going to break it all down step by step so you can absolutely nail this on your next exam. So here's our game plan. First, we'll tackle what deferred income tax actually means. Then we'll get into the calculations, how to measure and present deferred tax assets and liabilities, and finally, how IFRS and ASPE differ in their treatment. And then we'll wrap it all up with the final takeaways you'll want to remember. And as always, if you find this helpful, don't forget to hit like, subscribe, and turn on the bell. Because here on Canada Accounting Insights, we make CPA level accounting simple and practical. Okay, let's kick things off with a big question. Why do we even have to deal with deferred taxes in the first place? Well, it all boils down to one simple fact. Companies are basically playing by two completely different rulebooks at the exact same time. This right here is the heart of the entire issue. See, on one side, you've got the financial statements. Their goal is to play an accurate picture of the company's economic performance using accrued accounting. That means recognizing revenue when it's earned and expenses when they're incurred, not just when cash changes hands. But on the other side, you've got the tax return. And the tax man, he doesn't really care about the long-term economic picture. He just wants to know one thing. How much tax do you owe me right now based on the government-specific rules? Two different goals, two different sets of rules. And the result of this is that the income before tax you see on an income statement is almost never going to be the same as the taxable income on the tax return. This creates what we call temporary differences, things that are treated differently now, but will eventually flip back or reverse in the future. Deferred tax is simply the accounting tool we use to track and manage these timing gaps. It's the bridge between those two different worlds. Okay, so we know these differences exist. Now let's get a bit more specific. These temporary differences really come in two flavors: taxable and deductible. And figuring out which one you're dealing with is the absolute key to knowing if you've got a future tax bill on the horizon or a future tax break. This table is a perfect way to see this in action. Let's walk through it. For example, property, plant, and equipment, or PP&E. For your books, you depreciate it nice and slow over its useful life. But for tax, you often get to take a bigger, faster deduction up front called capital cost allowance. So here the book value is 100 grand, but the tax value is only 80 grand. That means you got a bigger tax deduction now. That $20,000 gap is a taxable temporary difference. Why? Because in the future, you'll have less depreciation to claim for tax, meaning your taxable income will be higher. That creates a future tax bill, a deferred tax liability. Now flip to the warranty liability. For accounting, you have to expense the estimated future cost of warranties right when you make the sale. But for tax, you only get the deduction when you actually pay out a claim. So that $200,000 liability on your books is a future tax deduction just waiting to happen. That's a deductible temporary difference, and it creates a future tax benefit, a deferred tax asset. So to put it really simply, a deferred tax liability, or a DTL, is basically a tax bill that you've kicked down the road. You got a bigger deduction today, which was great, but it means you're going to pay more tax later. The tax man will eventually come calling. And a deferred tax asset, a DTA, is the complete opposite. You can think of it like a prepaid coupon for a tax deduction. You've already taken the hit on your financial statements, but the tax rules haven't let you claim the deduction yet. When you finally do, it's going to lower your future tax bill. All right, enough theory. We know why different taxes exist. We know the two types. Now for the fun part, let's actually run the numbers. And don't worry, it's a super logical process once you see it laid out. It really comes down to just 3 steps. First, you comb through the balance sheet and find every single temporary difference. Step 2, you add up all the taxable ones, subtract all the deductible ones, and get one net number. Then you multiply that by the tax rate. And here's a huge tip. For exams, you have to use the substantively enacted rate. That means a rate that is officially law, not a proposed rate, not a maybe rate. It has to be a sure thing. Finally, step 3 is just making the journal entry to get the DTA or DTL on your balance sheet to match the number you just calculated. Let's put some numbers to that. Say a company has taxable differences of $50,000, maybe from PP&E, and some development costs. They also have a deductible difference of $8,000 from their warranty. First, we net them out. So 50,000 minus 8,000 gives us a net taxable difference of $42,000. Now we just apply the tax rate, which we'll say is 37%. And there it is. $42,000 times 37% gives us our magic number, $15,540. That's the target balance we need for our deferred tax liability account at the end of the year. See, not so bad. Now, hold on. There is one really important catch, especially when you're dealing with deferred tax assets. You can't just book this future tax benefit if you're not actually expecting to make any money. The rule says it must be probable, and that's a high bar, that you'll have enough future taxable income to actually use that deduction against. If a company is constantly losing money, that tax coupon is basically worthless, so they can't recognize it as an asset. Now let's pull it all together in a more comprehensive example. Let's walk through an example using Shark Manufacturing's year-end information. First, here are the temporary differences on their books. They have deferred development costs, creating a taxable difference of $32,000. Their depreciable assets also give rise to a taxable difference of $23,000. On the other side, there's a warranty liability with a deductible difference of $12,000. A lawsuit provision creates another deductible difference of $45,000. And post-retirement benefits give a deductible difference of $8,000. When we net all of this out, taxable minus deductible, we end up with a net deductible temporary difference of $10,000. Now, the tax rate here is 27%, so the deferred tax asset is simply $10,000 times 27% equals $2,700. So at year-end, Shark Manufacturing should recognize a $2,700 deferred tax asset. But that's not the full story. Last year, they actually had a deferred tax liability of $6,500. So we need to update the balance. After applying this year's amount, the ending balance becomes a net deferred tax asset of $2,700. That means the total change from last year to this year is $9,200. And because we're moving from a liability to an asset, this results in a deferred tax recovery. Once the calculations are done, the next question is, where do these numbers actually appear on the financial statements? Let's look at presentation and disclosure. Under IFRS, deferred tax assets and liabilities are always non-current. They can be offset only if they relate to the same taxable entity and the same taxation authority allows net settlement. In consolidated groups, offsetting is rare because each company files its own return in Canada. Financial statements must also disclose the split between current and deferred tax expense, impacts of rate changes, tax benefits from loss carryforwards, and a reconciliation between expected and actual tax expense. So far, we've mostly been in the IFRS world of IAS 12, but if you're studying in Canada, you absolutely have to know how this all compares to ASPE, or accounting standards for private enterprises. This is a classic exam question, so let's put them head to head. This table breaks it down nicely. Some small stuff. First, ASPE calls it future income taxes, but it's the same idea, and both agree these balances are always non-current, and you can never ever discount them. But the big one, the one you really have to know, is that second line under IFRS. You have to do the method we just talked about. It's mandatory. But ASPE, well, ASPE gives private companies a choice. And this choice is a total game changer. ASPE lets private companies choose something called the taxes-payable method, and if they do, they get to ignore all of this completely. Their income tax expense is simply what they owe in tax this year. That's it. It's way simpler, but you lose something. The financial statements no longer reflect those future tax consequences, so they're arguably less complete. To see that difference in action, let's walk through a quick ASPE-based example. Here's the information we're working with. Accounting income before tax is $250,000. They have a prior year tax loss of $160,000. Amortization expense recorded in accounting is $60,000, but for tax, they claimed CCA of $54,000. There's a warranty expense of $20,000, but only $15,000 of actual costs have been paid so far. They also have $5,000 in non-deductible fines. Meals and entertainment total $16,000, but remember, only 50% of that is deductible, and the tax rate is 30%. So with all of that, let's walk through two approaches. Under Scenario 1, we only look at the current tax payable. No deferred taxes here. When we adjust the accounting income to get taxable income, we end up with $114,000 of taxable income. Apply the 30% tax rate, and the current tax expense is $114,000 times 30% equals $34,200. And that's it. No deferred tax under this method. It's simple, but not as precise because we're ignoring future tax effects. Now, under Scenario 2, which aligns more closely with IFRS, we also account for temporary differences. These differences create deferred tax assets and liabilities. In this case, the equipment differences plus the loss carry forward generate deferred tax assets totaling $57,000, measured using the enacted tax rates. So here we get a more accurate picture by recognizing future tax benefits, not just what's payable today. Okay, we've covered the why, the what, and the how. We've even done the IFRS versus ASPE showdown. Let's wrap this all up and lock in the key points you absolutely need to remember. All right, here's your cheat sheet. 1. Deferred taxes are the bridge between accounting rules and tax laws. 2. Taxable differences lead to deferred tax liabilities, a future tax bill. 3. Deductible differences lead to deferred tax assets, a future tax saving. 4. Remember the big deferred tax assets rule. You can only recognize it if future profit is probable. 5. Always calculate using enacted tax rates and never ever discount the balance. 6. These balances are always classified as non-current. And finally, 7. Don't forget the ASPE advantage. Private companies can choose the simple taxes payable method and skip all this. And that's all for today. If you found this video helpful, make sure to like, subscribe, and tell me in the comments which IFRS or ASPE topic you'd like to see next. And remember, mastering deferred income taxes isn't just about memorizing journal entries. It's about understanding why those differences exist. Thanks for watching, and I'll see you in the next video on Canada Accounting Insights.